Ladies and gentlemen, greetings and salutations. Welcome to today's presentation for using the PowerOptions tools for radioactive trading. As we get started with the presentation, I have to type up a couple of quick polls. It turns out they did not save where I needed them to. So I'm going to go through and multitask here very quickly. And actually, you know what? We're just going to skip that today. So we're just going to go into the presentation. I may prompt you guys to use the question pod to send in the answer to some of those polls. I apologize for that. I really only had 2 polls I wanted to ask to help me gear the presentation. But yeah, we'll get to that. Let me just check something here. Looks like everyone is seeing my screen. If a few of you could be so kind just to use the question pod there to chime in and let me know how my voice is coming through. If you can hear me okay, just type yes, can hear you fine. Something quick there into the question pod. Okay, great. Thanks, guys. Thanks, Bob. Thanks, Ray, Fred. All right, everything sounds like it's going good. All right, well, we've got and Jim too, thank you. We've got a lot to cover today, and I want to leave time for your questions at the end, so we will just go ahead and jump in. Now, what we're going to discuss today is using the PowerOptions tools to implement the radioactive trading techniques. For those of you who aren't familiar with radioactive trading is a complete trading methodology developed by Kurt Frankenberg. What we do is we use a unique form of the married put setup, which we're going to talk about, to enter into limited risk, unlimited upside profit positions, unlimited upside potential profit positions. Kurt came about this technique and developed it after he had attended a weekend seminar learning how to trade covered calls, and in the first 3 months of following his guru's advice, he ended up losing all the money he had set aside for trading. And he decided he didn't want to give up on trading, but at the same time he wanted to enter positions where he knew he wouldn't be giving back to the market 40, 50, or 60% of his invested capital. After the position is opened, the initial married put position, we use 10 different income methods that are detailed in the blueprint to lower that initial at risk, potentially reposition the RPM, the limited risk position, generate income, and potentially bulletproof the positions. By bulletproof, we mean we have a guaranteed exit that is higher than our initial cost basis. And of course, the blueprint details the initial setup and the 10 different income methods. Some of you that have joined us today may be blueprint owners. Some of you may have just been introduced to radioactive trading. In fact, that was going to be one of my first polls, is do you currently own the blueprint, or are you just getting introduced to radioactive trading, or is it the first time that you've heard about it? But I'll gear the presentation for all of us to benefit from this without giving too much away, but also to help blueprint owners as well as assist new members to radioactive trading. Bob just chimed in and asked, is this being recorded? Yes, this is being recorded. It is going to be archived in the PowerOptions webinar archive as well as the radioactive trading webinar archive. We have an old one of using the PowerOptions tools for radioactive trading in the archives. This one is going to replace that. I hope to have it available in the archives, Bob, probably around 4:30, 5 o'clock this afternoon. Okay, now, that's what radioactive trading is. PowerOptions is a patented suite of search and analysis tools designed by Ernie Zerenner for self-directed options investors. Ernie created PowerOptions about 15 years ago after he had retired from Hewlett-Packard. He'd already been trading options positions for about 15 to 20 years prior to that. And what he wanted was a set of tools that would quickly help him identify the positions that matched his risk-reward tolerance. Now, our tools help you search the universe of options in less than a second to find only those positions that match your risk and return requirements. Once you've identified the positions, you can quickly compare the risk versus reward and analyze different strikes, for example, based on your preference for the stock. And we also have a powerful set of portfolio tools to help you paper trade, track, and manage your positions, as well as educational articles. And as I mentioned, we've been in business for over 15 years, and many more years combined trading experience. Everyone here on staff uses PowerOptions to trade their personal accounts. Now, what we're presenting today is about 4 years ago, Kurt Frankenberg was actually a customer of PowerOptions, and he signed up for a coaching session. And I was walking him through the tools on the site, specifically the historical tools. He wanted to identify married put positions historically that matched his base criteria. And after I looked at his position, I said, well, I don't understand what you're doing. I understand that you're limiting risk, but you're paying so much for the put that you're going to need such an increase in the stock in order to break even. And Kurt said, well, let me invite you to one of my free presentations. I'll show you exactly how I make money with this technique. Well, I was so impressed with the presentation that I invited Ernie to join me for the next two, and he was so impressed with the technique that we decided to partner up with Kurt. So the blueprint teaches us this limited risk trading technique with the 10 different income methods that are used off of it. But the synergistic combination, the patented PowerOptions tools, can help you find the initial married put positions based on your preference for the stock or your maximum risk threshold. Then you can further research and analyze those positions in the what-if scenarios. And we also have the portfolio tools, which help you track your radioactive positions, view potential adjustments based on the rules in the blueprint, and of course the analysis tools to help you apply those income methods after the stock has moved. We're going to spend some time on that, of course, as well this afternoon. Now, very quickly, of course, my name is Mike Shopguy. I'm the Director of Education here at PowerOptions. This is an old presentation. I apologize. It says I've been the Director of Education for 7 years. That should actually be closer to 9 years. I handle a lot of the coaching sessions and education. I've co-authored 2 books with Ernie, one on naked puts, one on protective option strategies using different forms of married puts and collars. And I am versed in all 23 strategies we support on the site, and I've been trading the radioactive techniques for over 4 years. I started off the same way most of you did. I started off with covered calls, and I kind of abandoned that strategy about 8 years ago, 18 months into trading the covered call technique, because it just wasn't working out for me. Whether it was just me still learning options at the time or still trying to identify stocks, fine-tuning my stock selection process, what would occur with me is the same that many of you might have experienced with a covered call strategy. I'd be getting ahead about the first 3 months in a row, earning about maybe 2.5%, 3% when assigned, being right maybe 70 to 80% of the time. But then I'd have a month, maybe 4 months down the row, where I was only right 50% of the time. And those 4 or 5 trades that didn't get assigned where the stock dropped, they dropped maybe 10, 15, or 20% over that time period. So when I looked at my portfolio overall, if I liquidated everything at that time, I was actually behind. Well, next 2 months, build up the account again, have a good success rate, earning 2.5%, 3% or so, and then a month after that, have another 50-50 win-loss ratio and be right back to square one. So not really getting ahead. And then I dabbled a little bit in diagonal spreads. And diagonal spreads, calendar spreads, actually, in the first 5 months or so of trading diagonal spreads, they were the most profitable strategy I ever traded. And then the next 3 months after that, it was the most devastating losses on any strategy I've ever traded as well. So I dabbled a little bit in iron condors and credit spreads. But what I do during the day with the different coaching sessions and webinars, I wasn't able to watch the screen enough to be able to profit. Those positions can get away from you very quickly, and I was missing opportunities to roll and then realizing the maximum loss or close to the maximum loss on a credit spread or iron condor, which would wipe out 10 or 12 previous trades. About the time when I left trading covered calls, I actually moved into standard collars. I still trade those in my account. And the reason why I bring this up is because I just want to be upfront that for the past 4 years, my trading account has specifically been made up at any given time. 50 to 60% of my invested capital is in the radioactive trades, the RPMs. About 20 to 30% of my investing capital is in standard collars, and then maybe another 5 or 10% of my invested capital is maybe on a credit spread or an iron condor on a broad-based ETF and index. And I've been that way for about 4 years, and the reason why I've been staying with 4 years is I've had more success long-term with the radioactive trading techniques than any other strategy I've tried, any other option strategy that I've tried. Okay? I just want to be upfront about that, but that's not why you came here today. So with that being said, the brief introductions, let's navigate over to the PowerOptions suite of tools. And actually, yeah, let me go back one. I apologize, folks. I haven't done this presentation in a while. We'll just review what we're going to talk about today very quickly. We're going to talk about customizing the search tool, using the married put search for the radioactive profit machines, and how you can customize that based on your needs or your stock requirements. We're going to discuss how we then, my process of how I analyze a position. Once I've identified a married put position, how I identify it and compare it to other strategies. Of course, run the catastrophe report using the profit and loss chart to help maybe with my alerts, for example, meaning upper stock limit, lower stock limit, not necessarily exiting the RPM, or when I might look to apply an income method, for example. And then, of course, we're going to get into the portfolio. I really want to spend a fair amount of time on the portfolio to help you all get acquainted with how you can use the portfolio to not only show where you stand on a given position, but also make sure you're all comfortable with how you can do the research and analysis and view the potential income methods or adjustments, simulate the potential income methods, and then apply those income methods into your account. And that'll also apply to any strategy, not just the married puts, but we're only focusing on the radioactive trades and married put positions today. All right, now let's navigate over to the PowerOptions suite of tools. Now when I'm looking to identify a new position, I want to get into a new RPM, a radioactive profit machine. Where we'll start off is I'll go into the married put tab. If you don't have the married put tab on your screen, you just want to go into the other strategies tab here on the far right, and you can pick and choose which strategies you have selected. So you want to make sure, of course, that you have the married put strategy added to your available tabs. Okay. Now, if I have a stock in mind and I'm looking to open a new position, a lot of us may have, a listing of maybe 10 or 15 stocks that we've traded over the past 5 years. We like to go into with different strategies from time to time. We see a pullback on that stock that we've traded and we feel it's going to move up in price. Well, if I'm looking to open a new married put position on a stock, just a single stock, we'll start off in the search by symbol tool. Okay, let's go ahead and click on search by symbol. And it'll prompt us to enter in our stock symbol, and I'm going to use PXP. This is an RPM I had open recently that I just closed, and I'm looking to potentially maybe get back into it because I'm familiar with the stock and it's had a pullback. Now, I don't know off the top of my head every expiration cycle for this particular stock. It defaulted to June, but as radioactive traders, we know we want to go further out in time, and we'll talk about that when we go into the search tool. So I'm putting my stock symbol, and I'm going to start off with all months. Now we have some default filters here using less, more, and all. I'm going to switch it to more right now and click submit. Now many of you that have downloaded the sketch, that free white paper at radioactivetrading.com, maybe you've joined Kurt or myself for a free live webinar or watched an archived webinar on YouTube or on the site. And for those of you who own the blueprint, you see our first results here that come up. We have some May series and we have some June series, which are 38 days out in time. But you know that we're typically looking for put options that are at least 150 days out in time or more. That matches the 3 core principles of radioactive trading, one of the 3 core principles. So even though I selected all months, what I want to do now is I'm going to scroll down the list, and you see we have our days to expiration for each month that comes up listed in parentheses. So there's 101 for August, still probably a little too close. The first month I see that matches what I'm looking for is November. It's 192 days out in time. I've got 255 days to January 2013 and then 619 days to January 2014. So it looks like November may be my first series. So what I'll do now is scroll back up to the top. We're going to click November. So I want to see the at-risk amounts for the November put series, matching these behind-the-scene filters, the more results there on PXP. Now in general, many of you know that what we're looking to accomplish with the radioactive trading techniques is we are buying shares of stock. All right, so PXP is currently trading at 39.11. And at the same time, we're going to buy an in-the-money put option that's at least 5 months out in time. And we want to look for risks that are in single digits, usually between 3.5% to maybe 9% or so. So in this area here, these 3 puts match that base criteria. I have a 6.7% risk, 7.6, and 8.6. If I wanted to be more conservative at this time, we might go ahead and change this now to all results so I can look at the other positions there. All right, and this opens it up a little bit more. Now we have a wider range. So we start off with, let's start off with that 8.6% going to the 41 put strike. And even though we have some that are down in the 4% risk, 3.9 to 3.4, I'm probably going to just focus in this area here. And the reason why is one of the other default settings we're going to take a look at when we go into the search in just a moment is, yes, we want to be at least 150 days out in time, but we also want to keep our range in the money. We don't want to go more than 20%, maybe 25% in the money. So I want to be in this range here. I want to be less than 20% in the money, and I want to keep my risk in single digits here. So let me just go ahead and X this out. And there's also another way. When we go into the search tool, I'm going to show you an easier way to help evaluate these positions one stock at a time. I just wanted to illustrate this first. Okay, so let me re-highlight those positions. I apologize, that disappeared on us. Let's just highlight these positions. There we go. I want to be in this range here. Okay. So we have a wide range here, single strike options between the 41 strike and the 48 strike. Now, whenever I'm analyzing getting into a new married put position, the first thing that I want to do is evaluate the stock chart. Okay? In the blueprint we talk about the SIGA model. What are the current conditions? What are my expectations? What are my goals? And that helps dictate the action. Well, that applies really to the 10 different income methods. Each income method has a different SIGA model, but it also applies to when you're opening a position. And for those of you trading other positions, you should apply the SIGA model to that as well. Whether you're doing covered calls or even bull put credit spreads, you should apply that basic SIGA model to those positions before you open them also. Now, what are my conditions? Well, my conditions are, I know this stock, I'm interested in opening an RPM, had a pullback recently, and I think it might move back up in price. What are my expectations when I'm opening this new position? Well, now what I'm going to want to do is take a look at the stock chart. So up at the top, using the More Information button, I'm going to select Charts, and I want to go to Big Charts. Now, we're not going to talk too much about analyzing a chart, how I analyze a chart versus what you look for. But what I'm looking at here, let me narrow this down to just a 6-month chart here. And with the big charts, of course, you can change this. You can add indicators such as the Bollinger Bands, moving average envelopes. If you wanted to look at MACD, RSI, you could change that as well. But as I mentioned, this stock, as many others have, has had a recent pullback. You know, we've seen a couple months ago we had a peak here at around $46, $47 per share up in this area. Since then, it's had a steady decline. A spike in volume recently. Looks like it spiked up, but then it came back down. And it's been pulling back here, and we've got low volume today. So this might not be a chart that you agree with for getting into a position, and I'm definitely not making a recommendation or suggestion. This is just an example. Let's say even with this pullback, I feel that the stock may come back to $42 or $43 per share in the next 30 to 60 days, and over maybe the next 90 days may go back over to 47. Now, why is that important? Well, it's important when opening a new RPM, you want to have your expectations mapped out. Now, we have these opportunities that match our risk and are in the money range, as we saw, ranging from the 48 put all the way down to about the 41. Now, all of these are good at-risk levels, and you see here the closer we are to the current stock price, the higher the risk. As we go deeper in the money, we get to those lower risk ranges of 4.5% and 4.7% with the November 49 and the November 46. But when I'm opening an RPM, what I'm looking for is that, okay, in the next 30 to 60 days, I think the stock might be trading up around $43 or $44 per share. So I'm going to want to focus on those areas. The reason why is the best time to apply an income method, whether you choose to do income method number 1, just selling a call, which is given away for free in the sketch, or you're considering doing one of the other more conservative income methods that I use, such as income method number 4, rolling up the put strike price to kind of limit our risk further in case there's a pullback. The best time to apply any income method if the stock is when the stock is trading right at your put strike price. So even though this 45, 46, and 49 strike give me a lower risk, and they're still kind of within my in-the-money range here, at least the 48 and the 46 are, but they have this low risk of 4.5 or 4.6%. If I don't have an expectation that within the next 30 to 60 days the stock would be trading at these strike prices, I'm going to be sitting on that position for an extended period of time before that happens. All right? So even though these have the higher risk, 6%, 6.7%, they still match my risk threshold. You know, being under about 8.5% risk, maybe 3.5 to 8.5% risk, and they match my expectation of where I think the stock's going to go. So what I want to do now is, okay, well, I have these two comparisons. One's a 6% risk, one's a 6.7% risk. Well, if I think I'm okay taking a 6.7% risk, and I think the stock's going to be trading, has a better chance of maybe trading up at $43 per share, well, I want to maybe take a look at this November 43 a little bit more. And what I'd like to do is go to the profit and loss chart. Of course, the profit and loss chart gives us a static view on this position. And let's quickly review, if we just did 100 shares of this position, what we'd have. Well, we'd have stock at $39.11. We're buying a November 43 put, and we saw that it has about 190 days to expiration for $7. Our total investment would be $46.11, but we're guaranteed an exit of $43 per share. So our maximum risk is $311 on this position, or 6.7%. Now, I mentioned our total investment is $46.11. And you see over here on the left that that's the break-even. Well, that is the break-even at expiration. Okay, if we hold the position, just take a look at the blue profit and loss chart. If we hold the position all the way to expiration and the stock is trading below 46.11, well, we'd have a loss. And if it's trading below 43, if we hold it to November expiration, make no adjustments, the stock's trading below our put strike price, we'll realize that maximum loss of 6.7%. However, let's add this back in. This curved red line shows us the break-even over here on the left at the halfway point, 8/14. August 14th is the halfway point between now and June expiration. And we can see from the chart that the break-even at the halfway point is really closer to about 42.80. We don't need the stock to go all the way up to 46.11. If the stock was trading around 42.75, 42.80, we'd be at break-even at 8/14. Well, that's good, but what I'm really expecting is hopefully my stock will move up in price. We mentioned in the next 30 days, I think the stock might be trading at $42 or $43. Let's take the halfway point. Down below, we can analyze this chart taking the halfway, or I'm sorry, using our own expectations. So I'm going to put in a price of $42.50. 30 days from now, we'd be at June 10th, roughly. June 9th, June 10th. We have the 8th and the 11th. So let's use the 11th, roughly 30 days from now. And we'll hit calculate. All right, now down, but it redrew our curved red line for us. And over here on the left now, we're looking at the monetary values if the stock was trading at a certain price on 6/11. Okay? And we see here that if the stock managed theoretically to move up to 42.50 using the Black-Scholes pricing model, we'd gain $339 on the stock, but we'd be giving up $227 on the put. But we'd still realize a profit. Remember, the put doesn't decline one-to-one with the stock the way we set it up radioactively. So, in this case, we see if the stock was trading at about 42.50, we'd be probably right about here in this profit range. If the stock was trading at $43, we'd have a profit of $139 at this point. We wouldn't need the stock to reach 46.11 to break even. That's only at November expiration. Okay, so what I'm doing here is I'm kind of running my what-if scenarios. Here I have a profit of $112 if the stock was trading at 42.50, again, theoretically using the Black-Scholes pricing model. If I do enter this position, I might use that as an alert in the portfolio. I might set an upper stock limit of 42.50 or maybe 42.75. When that alert is triggered, that's when I might start looking to apply one of the income methods. Maybe I want to sell the 43 or the 44 call depending on the prices. Maybe I'd want to roll the put up in price. Maybe I'd want to do one of those nested spread trades that we're going to talk about tomorrow at 12 p.m. Kurt's going to present some of the nested spread trades, income method number 6, maybe your income method number 5. So that's what I might use this for. Now, of course, I also want to run the other worst case scenario, the catastrophe report on the other side, meaning, well, here, going up to 42.50, that would be a gain of about $3.40 from where the stock is. But what happened if the stock dropped down about $3.40? What happened if it declined to $35.50 in the next 30 days? Now, remember, my maximum risk is $311 on the position here. If I hold it all the way to November expiration, make no adjustments, and our stock's below 43. All right, so let's go ahead and calculate that. Well, even if the stock goes against us, it drops down to $35 per share, theoretically we'd have a loss of $361 on the stock. And we'd have a gain, theoretically, of $188 on the put option. So we'd only suffer a loss of about $173, which is about half of our expected loss. Now, why I bring that up is because if that does happen in the next 30 days, if the stock goes the opposite direction and pulls back to 35, there are income methods discussed in the blueprint that I could use to help me manage this position. But, if I decided that this was just a bad time, I was wrong on the stock, maybe I don't see it coming back, well, if in the first 30 days my sentiment has changed because the stock has moved down, maybe it's okay to just liquidate it, take maybe that 3.5 or 3.4% loss. If I was okay risking 6.7%, I'm okay taking a loss of only 3.5% with about, think about this, the stock's at 39.11. If we drop down about 350 or so or 340 or so, it's almost a 10% decrease, and we're only going to lose about 3.7% on the position. That might be okay to tolerate, and then we can look for another stock at the new time. All right, so that's just briefly analyzing stock that you own using the search by symbol tool. And the real comparison, what it comes down to is, I know I went over that quickly, but what you're really looking at here is comparing what matches your risk and your expectation for the stock going forward. You want to evaluate the strike prices of where you think the stock might be trading in the next 30 to 60 days based on your risk threshold. If you like to be more conservative, well, there's no problem going more in the money and taking that lower risk. You want to be more aggressive? Maybe you want to look at these higher ones, 8.6 and 9.7. Those personally just don't match my risk-reward tolerance. All right, if anyone has any questions about just using the search by symbol tool, go ahead and send those in. But we want to get moving along here. I will handle your questions, of course. I won't ignore them. But I want to move over to the search tool because that's where the real discussion we want to get into. Let's say we don't have a stock. We're looking to open a new RPM. We want to look across the universe of options for positions that match our risk requirements or the default settings and the discussed in the blueprint. Well, to start, I'm going to go into Married Put again, and we'll go into the search tool. Now, the search tool allows us to scan across the entire universe of options in any strategy to identify only those positions that match our risk-reward tolerance. Now, when we first open the search tool, we see that we have a variety. Oh, sorry, folks. We have a variety of different trades. And again, these directly aren't recommendations or suggestions. As we scroll down below the listed trades, I want to take a look at the parameter field here. And the parameter field allows us to tell the system what types of married puts we want to see. Now, this particular screen, we're starting off with the default RadioActive trading criteria sorted by earnings per share growth. Kurt and Ernie feel strongly that, if you're expecting a stock, let's say you're expecting an annual return of 12 to 15%, trading long stocks in any strategy, even covered calls, for example, standard collars, which I also use, or the married put positions. Well, you should probably expect that your stock has at least a 10 to 12% earnings per share growth. Okay? If the earnings aren't positive, if the stock isn't growing in earnings, we shouldn't really expect it to be growing in price. Now, that's not to say that every stock that has a positive earnings will grow over time. It's also not to say that every stock that maybe has a lower earnings per share growth or negative earnings per share growth won't grow over the next 12 months. It's just a good filter to use that kind of reflects good management and a strong company. So we're sorting it by the highest earnings per share growth to lowest to look for those types of growth companies. But let's talk about the base criteria. There are close to 25 to 30 different option criteria you can use in the screen and about 25 to 30 different stock criteria. But if we take a look at all the greater than and less than columns, our center section here is mostly our option information and combined option and stock. And the stock price range is, over here on the right is all our stock criteria as well. You notice there's not that much filled in for things, even as I mentioned, earnings per share growth, price to earnings, beta perhaps, broker recommendation if you like to use that. There's some filters for average stock volume. There's not a lot of criteria put into this screen. Why? Well, it's because Kurt prefers to look for the married put positions using the IBD 50 and CanSlim, the Investors Business Daily 50 stocks and the Investors Business Daily CanSlim list. A lot of those filters such as positive earnings, earnings growth, average stock volume, minimum beta, things like that are already taken into account in order to match that list. Now, Bray, I see your question. I'm going to get to that in just a second. The settings over here on the left, we've talked about that before. We see that we're using the default criteria here. We're looking for all months of expiration, but we're limiting the time frame to be at least 150 days, 5 months out in time, to roughly 900 days. And we could probably limit that down to 650, as we saw earlier. January 2014 right now is only about 619 days to expiration. You see here that we have a range also of in the money. We're looking to use those in the money puts that are far out in time, and we use the in the money puts because that keeps our risk level within that single digit percent, that at-risk amount default view of 3.5 to 9%. Okay? So we don't want to go more than 20% in the money. And the reason why is I can find lower risk. If I go 40%, 50%, 60% in the money, I might find risks of 1%, less than 1% even. But the problem is if I go that deep in the money, my expectancy of profit is really low. I now need a larger move in the stock price in order to make it really logical to apply those different income methods. So we don't want to go more than 20% in the money or no more than a couple of strikes in the money as well. Now the reason why I'm highlighting these three criteria is that these three criteria really express the three core principles of radioactive trading. These are the ones that reflect the three core principles. And the three core principles are forcing an ideal size trade. Well, that's handled by our at-risk amount. The radioactive decay line, meaning that when you're selling options, you want to sell shorter term. You want to sell nearer term. And we take advantage of that with the income methods. So you want to sell time dear. You want to sell time at a premium when you have the faster decay. But when you're buying options, whether you're speculating on a stock movement with just long calls or long puts, or you're using options as a hedge, when you're buying that, you want to buy further out in time so you get a lower cost per day. Yes, the time value price is more up front, but when you spread that out, the option that's 6 months out in time is not going to be 6 times the cost of the current month option with the same strike. Okay? So this allows us to take advantage of the radioactive decay line. And then, of course, the at-the-money bell curve, the other core principle is handled here with a show in the money range. And the at-the-money bell curve teaches us that when we're buying options, we typically want to buy in the money or out of the money, so we're paying less time premium. And when we're selling, maybe using those income methods, we want to be selling when the stock is trading right at our strike price, when the options are at the money. So we're forcing it to be in the money, and then also out in time for the radioactive decay line, and forcing an ideal size trade by limiting the risk. Now, Ray asked a question, why limit the stock price to $200? Well, most investors may not have the capital to go into larger stocks with a married put trade, say $400, $500, $600. And this default criteria is what Kurt discusses in the blueprint. This is what he used when he first starts looking for a new married put trade. This is the same criteria he's used for the past 10 years in the radioactive trading techniques. But you want to adjust this criteria based on your preference and what you're looking for. And what I mean by that is that, okay, I'm comfortable with these days to expiration, but I find myself personally, usually I open a put option that's more along the lines of 6 or 7 months out in time, maybe 100, maybe around the lines of 200 days out in time or more. I think on average, the put that I buy is about 8 months out in time. I'll use leaps occasionally as well. I know that I don't want to change this, okay? The range in the money, you could change that if you wanted to limit it so you're no more than 15% in the money as opposed to 20. You could change the days to expiration too, but you really don't want to go below that 150. And for the percentage at risk, well, this is a personal tolerance. Yes, the default criteria, we're telling the system to look for married puts that have a risk between 3.5 and 9%. But my personal risk tolerance is more along the lines of 3.5 to 7.5%. And Ray, regarding your question, why limit stock price to 200? Well, I personally fall into that category where my trading capital now dictates that when I'm doing married puts or standard collars, I'm typically only buying stocks in the range of maybe $5 to $55 per share. If I purchased a position, I could afford to go into a stock that's trading above $200, but I'd only be trading 1 or 2 married puts instead of maybe 4 or 5. Okay, so it's personal preference to what you want to see. But the idea is you can customize this. So Ray, if you wanted to look for married puts that match your risk threshold still at least 150 days out in time and match the strikes, but you're okay going, let's say, up to $350 or up to $400 per share, you just put in your preference. Okay, that's what this is designed to do. I'm going to keep mine in my range. Now the historical volatility here, that's put in there because we want to see stocks with some movement. So Ernie and Kurt suggest putting in a limited volatility for the stock of 0.25. But I want to point something out here. I want to point out 2 things. Let's say that we're doing these married put techniques. I've adjusted my risk threshold. I've put in my stock price. But I also want to use dividend-paying stocks in my, excuse me, I want to try to use a dividend-paying stock. So I'm going to put in a minimum dividend yield here for my married put search of at least, let's say, 3%. And we've got our historical volatility. Average stock volume. The average stock volume is measured in thousands, so this shows us we're using at least 300,000 shares minimum average over the last 90 days. and I've got the IBD 50 list and my stock price above the SMA 50. Well, let's go ahead and run that search and see what we get. Okay. No stock option combinations match my search criteria. This is what I expected to see. When you see this, it means your search results are too restrictive. Now, it doesn't look like this should be too restrictive, should it? You know, we've got a good 50 to 70 stocks, maybe in that IBD 50 and CanSlim list. We saw several that were within that price range of $5 to $55. We know they're in our limited risk range of 3.5% to 7%. But the issue here is now that I used a dividend paying, or used the percent dividend yield. There's two tricks now in this from the default settings if you're looking for a dividend paying stock. Number one, a lot of stocks that pay a dividend will not have a historical volatility above 0.25. You think of stocks such as Kraft or maybe even IBM, which pays a smaller dividend. These positions move much less frequently, and we're talking along the lines of maybe a volatility of 0.18 or 18% or around 0.2 or 20%, for example. In addition to that, there's another catch. The other catch is the IBD 50 and CanSlim stocks. There's only a small amount of stocks that pay a dividend in the IBD 50 and CanSlim list. Now, let's take out the historical volatility, leave the IBD 50 and CanSlim list, and submit that now. So we're still looking for married puts that match our stock and our risk criteria, but it has to be in the IBD 50 and CanSlim list and pay a dividend. We have 7 results, but really we only have 2 stocks. Okay, we've got Duke Power here and Altria Group. Now, I'm not saying these aren't good positions, but if I want a broader range, if I want to trade a married put on a dividend-paying stock, the way that I would open up the field is I would remove the IBD 50 and CanSlim list and just select no lists. Or if you tend to follow more along the Standard & Poor's list, you could select a screen for married puts against the S&P 100, the S&P 5 stars, maybe even just the S&P 500 stocks or the NASDAQ 100 stocks. Maybe I just want to look for new married puts on NASDAQ stocks that pay at least a 3% dividend yield. Okay, so you can customize this based on your preference. I'm just showing you a couple tricks here. And Rob says IBD CanSlim. The IBD CanSlim is the Investors Business Daily 50 stocks and what's called the CanSlim, the Investors Business Daily CanSlim list, Rob. The CanSlim is an acronym. I don't know off the top of my head exactly what it stands for, but it's revolved around, positive earnings and average stock volume and things of that nature. So there's just the 2 Investors Business Daily lists. Sorry, folks. I'm going to change this to no lists. Now, when I'm opening a married put, remember we talked about this, I'm looking for stocks that I think have strong management, good growth potential, and really I'm looking for stocks that I feel may have the potential to gain 5 to 8% over the next 30 to 60 days. So I removed the CanSlim list and I selected no lists. And even though I'm looking for stocks that pay a dividend, I'm also going to want to put in some of these other criteria that we may not be filtering for now. We talked about the earnings per share growth. Well, maybe I want companies that have grown at least 7% in earnings from last year to this year. You could also use the PE ratio. A popular one is maybe between 0 to 50 or 0 to 70, for example. Average stock volume. Personally, I like to increase this also. Instead of 300,000 shares per day on average, I'm going to go up at least 750,000 shares per day. I have no statistics to prove whether that using this type of criteria is better than using the IBD 50 and CanSlim list, but this is kind of the criteria with or without the dividend that I've been using for the past 3 or 4 years. Now, of course, we do still want to look for a stock trading in an uptrend. That might also be a problem hindering our results right now. We know that we've been in a pullback the last few days. But if you use things, other criteria, if you do use average broker recommendation, if you do like to use beta, for example, you can put those in as well. Now, let's go ahead and submit this search, dividend search. All we did is change it to no list, but we put in some of those other fundamental criteria. Now I have a wider list, but it's still a reasonable, manageable list. We have 40 total results, and again, I'm filtering this, by the highest earnings per share growth to lowest, looking for the stocks with the highest earnings per share growth. Okay, so we've tweaked our criteria. Your criteria may be different than mine, but that's what we want to use the search tool for. And you see up here at the top, I just want to show this as well, we have our basic criteria. We have our stock symbol, a current stock price and change today, our put option specifics, the put ask price here of 270, our total net debit, our monetary and percentage maximum risk. And then I've added the earnings per share growth, percent range in the money. I show the delta here for a reason. We'll talk about that in the percent probability above. But if I wanted to see the dividend yield as well, if there's a column or a filter that you use that you want to see in your search screens, just click the See More or Less Columns button. And this allows you to pick and choose which data columns you're viewing in the field. And we wanted to look at the dividend, so we'll check that. The stock information is on the left, your option information is on the right. So let me scroll down now and click Save and Return. We'll be prompted to refresh the page there, so let's go ahead and take that. Steve asks, have you tried the, I think you meant Zacks list. It came across as Z-A-C-K-A, but I think you meant the Zacks list. You get any different or better results? I believe this is based on earnings surprise. Steve, no. I have not used a different list, the Zacks list there. Sometimes I will use that S&P 5-star or a combined S&P 5-star with the IBD 15 cancel list. You can set that up as well in that recommended list field by combining your own personal lists. But I've never used that myself personally and can't comment on it if I found it's been better or worse. Okay. All right, so I just wanted to add the dividend yield. That just shows you how you can add the different columns. Now, I have never seen this stock before. What I can tell from this stock is that it matches my criteria. This married put position is within my limited at risk range, you know, that 3.5 to 7.5%. Does have a strong earnings per share growth, and it pays a 3.5% dividend. I also know right now that this stock, of course, paid, I should say, is trading above the 50-day moving average because I selected that as well as one of my screens. Now, I don't know the stock. I like the numbers here, but what is my first step? What was my first step now that I have my search results? Well, we're going to use that More Information button, and the first thing we're going to do is exactly what we did before. I'm going to take a look at big charts, okay? I want to see, is the current trend, maybe of the last 60 or 90 days, something that I feel is a bullish stock that may increase in time. Let's change this to 6 months chart again. Well, something has happened recently, and it happened on low volume. That's kind of interesting. We see here we had this nice little gap back at the end of April. The stock jumped from $27 to about $29 per share, and it's been holding that price. That did it there too. There might have been an earnings event, but it didn't look like there was a major increase in volume during that gap time period. Okay, so we're looking at the chart, and again, I'm not going to talk about how we analyze charts, or everyone has their own way of doing it. But if I think because of this move, and it's been holding that for a while, that this might be a stock that has a potential to continue to move up in price, this might be a good candidate for a married put position. However, if I took a look at this chart and I said, well, this is just based on this event, and the last time it had a gap here, it pulled back, and over here we had a large gap, and then it pulled back as well. Maybe if I think the stock is due for a pullback after that large gap, even though it's been holding it, well, I'm just done. Okay, if I don't like the chart for whatever reason, I'm just going to leave that position alone, and I'll move to the next one. I'll take a look at Lin Energy, and we'll open the big charts there. Take a look on this one. Does this one have a better chart? Maybe not. You know, I had a recent pullback, for example. Maybe I do feel like PXP that this stock's going to move up, but I don't know this stock that well. I've never traded this one either. Okay, so you want to make sure that once you have your results, you've narrowed down your results, take a look at the chart. Whatever settings you use on that chart to help you identify a position, what you're kind of looking for is a stock that you feel has the potential to move up 5 to 8% in the next 30 to 60 days. Okay, personally, after I take a look at the stock chart, if I decided I liked UGI's chart, the next thing I want to do is I'm going into the company information, news, and profile. I don't even know what these guys do, so I'm going to take a look at the profile, just see what sector or industry they're in, where they are based. And I'm going to take a look at the recent news headlines. Why do I want to look at the news headlines? Well, I'm going to scroll back in the news headlines, maybe 30 to 60 days, maybe not even that far, but I want to scroll back. What I'm looking for is there anything that might cause me hesitation for entering this position? Any rumors of perhaps a buyout? Well, that might actually work in my favor, but I want to be aware of that. Anything about a boardroom scandal? Anything about an earnings surprise? Anything about a patent lawsuit? These are things that might cause me hesitation for entering into the position. So that's what I want to do as well. After I've taken a look at the news and the profile, so we go charts, make sure we like the chart. We get further insight into what the company does if we're not familiar with them, you know, what kind of industry or sector they're in, what kind of headlines they have. And then what I'd like to do is say, okay, well, I'm good with UGI. And we're looking at a stock trading at 29.19, and we see the October 30 put with an at-risk of 5.9%. Was there a 31 put? What about the 29 put? Well, I wouldn't want to do that because it's out of the money, because it probably wouldn't match my risk. Otherwise, it would have shown up. But if I'm curious as to why there are no other strikes on this stock that match my results, well, now we'll take a look at search by symbol. Okay, we saw that before, so I'm just pulling this up for October. And okay, well, it looks like this is probably the best deal. I do see, because of odd pricing, the option that's deeper in the money, the October 35 put, actually has a higher at risk, and that's probably due to a wide bid-ask spread here. It doesn't have single strikes. We show the October 25, the next strike out of the money. We wouldn't do that. Now we see why. Right? We always want to go in the money for that single-digit risk. We go out of the money here. It's a 17.1% risk. I don't want to take that. My risk threshold was 3.5%, or 7.5%. My apologies, ladies and gentlemen. So highlighted for me is the 30 put I was analyzing. It's a 5.9. I could get a little bit lower by going to the October 40, but again, that's outside of my range, isn't it? I didn't want to go more than 20% in the money. This is 30% in the money, so an expectancy of profit or availability to trade an income method, I'm going to need the stock to have a much larger move before it's trading around 40 to make any adjustments on the position. Okay? All right, so let's go ahead and close that. So that's my next step. I want to look at the different strikes, see if there's something I might be missing. I could also go to different months. Maybe this offers leaps. Well, let me take a look at January. Is there anything out in January 2013? Nope, didn't have any of those there. So let's go ahead and close that down. Okay, so these are the positions. Frank said look at HBC. Frank, I don't think we're going to have time to do that. If we have time at the end, because we still got to go through the portfolio tools. But as I mentioned, if you're on a Power Options trial, you're on a Power Options subscription, you can easily, at any time, just as we did at the beginning, go into Married Put, go into Search by Symbol, take a look at HBC, take a look at those months at least 150 days out in time, kind of analyze your risk reward there, see what matches what you're looking to accomplish. Okay, and like I said, if we have time after the question round and after we go through the portfolio, it's really important that we go through the portfolio. Then I will go ahead and take a look at maybe HBC. There's also another tool I want to show as well, but we'll get to that later on. Okay, so let's say now, we had UGI, took a look at big charts, took a look at the news, information, and profile. Did the search by symbol to compare other strikes. And as we did before, my next step is I'll look at the profit and loss chart. Okay, why am I looking at that profit and loss chart there? Same thing we did before. I want to run the catastrophe report. Well, here's our profit and loss chart, and then profit and loss, the halfway point with our curved red line. I would have opened this position. Remember what we talked about. I would have opened this position if I thought the stock was going to move up maybe 5 or 8% within the next 30 to 60 days. So let's say the stock does go up as we expect, is trading around $30.50 in the next 30 days. So we'll go to 611 here. There we go. Click on Calculate. And all right, so we see we'd have a very small profit of about 31 cents, it looks like, based on the Black-Scholes theoretical price for this particular position. And then, of course, I'd also run my other scenario. What would happen if the stock declines? A couple of points, let's say it dropped down to 28.19, dropped a full point by 611. Well, our maximum risk was $189, so we'd have a $99, but almost $100 loss in the stock. Put didn't really react too well. This must have a very low volatility on that. So we'd have a loss that's about half of our expected loss. We'd be at about a 3% loss there, 2.9% loss on the position. Okay, so we're just running our what-if scenarios, maybe just deciding to use that to help us set our alerts or upper lower stock limits when we might consider to analyze a bearish income method based on the rules in the blueprint, the combination of income method number 9, maybe 9 and 1, maybe even income method number 6. Or if the stock moves up, of course, looking at the other income methods, the bullish income methods 1, 3, 4, and 6, and perhaps 5 as well. All right, and then of course if the stock stagnates, you still do have 6, 7, and 8 that you can use in the first 20 days, but that's all discussed in the blueprint. All right, very quickly, one thing I want to show you. Now remember, after you've adjusted your criteria, remember you can always save that search just by clicking the Save button. So now whenever you come back to the Married Put screen, you'll have your saved searches along with the 2 default searches. Okay, so you can always customize it and you can have different searches. This is our webinar account. In my own personal Power Options account, I have similar things set up, meaning that I have the 2 radioactive defaults. I have a married put screen that I use kind of with Bollinger Bands, maybe looking for a breakout. Dividend paying stocks, I'll have a specific search for that because it's a little bit different criteria. And then just my base married put search with my price criteria, maybe using that combination of IBD 50 and the S&P 5-star stocks or other fundamentals. So you can have as many searches as you want really saved here. Okay, back to square one. Got our search, had our results. First one sorted by what we wanted, the earnings per share growth, great. We looked at the stock chart, company information, news, and profile. If you wanted to delve really deep into the stock or the option research, you can do that through the research menu. And I just wanted to show this real quick. I believe it was for Rob's question, was it earlier? I apologize. But the stock research tool shows you all the data on one page that we have for that particular stock. And including on that, the question was asked earlier about what about the Zacks list for earnings surprise. Well, here you have the earnings per share information, the last quarter, the surprise for last quarter, the estimates for the next quarter, this fiscal year, and so forth. You also have your broker recommendations as well, and all of that fundamental and technical data that we have also. Okay, so that's there as well. Oh, quick question came in. Sorry, folks. James asked, he might have got in late. Oh, yeah, he got the invite late. I apologize for that, James. As we mentioned at the beginning of the presentation, we are recording this webinar. I hope to have it available in the Power Options webinar archive by about 5 o'clock, 4:30, 5 o'clock this afternoon Eastern Time, of course. Okay, so now that I've done all my research and analysis, what we want to do now is we're going to want to place the trade. Now in Power Options, if you have an Options Express account, you can use the broker link, and then this will allow you to enter it as a married put, so it'll take you to the Options Express or Brokers Express interface. You can enter it as a married put position. You can choose to leg into the position by buying the stock or buying the put as well. We are in conversation with other brokers to potentially enhance the broker link of what brokers are available right now. So we're looking into that, but right now it's just Options Express and Brokers Express. If you're using a different broker, well, I would just log on to my brokerage account. As I mentioned, I think I mentioned earlier, maybe I didn't, but one of my accounts is Fidelity. A restricted retirement account is in Fidelity. So I would log on to Fidelity and place my trade. I'd put in my order for buying shares of stock UGI and buying my October 30 put. And using this as a net debit, I might put in a limit order to get filled on both positions. And so if I'm using a different broker after I get filled, I'm going to come back to Power Options. Then I'm going to go to Add to Portfolio. Let's get into the portfolio tools. Now, if you haven't created a portfolio in your Power Options trial or subscription account, when you first click Add to Portfolio, it's going to pull up a default portfolio for you. You're just going to see new portfolio number 1 here, and I can put in a name for it. We can call it Married Put Test or RPM positions. We could call it RadioActive Trades. Okay, and it's going to start you off with a default cash on hand basis of $100,000. You can always go back and change that. For today's presentation, we're actually going to include this little UGI put, and again, please do not think this is a recommendation or suggestion. I'm just using it as an example because it was the top one, and I'm just walking through the process of how I use Power Options to research and analyze a new married put position. So I'm going to put this into my married puts 2012. So let's go ahead and click Insert. And this will fill the information in for me. Now the search tool doesn't know how many shares I'm planning on trading, okay, but it linked over the stock, the put option we were researching, today's transaction date, and the current price and the price for the put option. Let's keep things simple as a paper trade. We're going to just put in 100 shares and 1 put. We're going to treat it as a paper trade, so I'm going to put in 0 commissions. Of course, maybe I would put in a commission for my stock of $7.95 and a commission for my option of $5.95, whatever that is. And of course, if you got filled at slightly different prices, you could adjust those as well. You know, if you actually got into stock at $29.15, or you actually got between the bid and the ask and were filled on the put position at $2.65, for example, we put that in as well. Okay, Lloyd, you asked a difficult question that I'm going to get to in a little bit. I might save that for the question answer. I know we're getting close to 1 o'clock. We may go a little bit over. And I want to make sure I try to cover everything here. So I'll get to that question, Lloyd, I promise, but I want to go through here a little bit more. All right, let's go ahead and click Submit. And this will link us into the Profit and Loss Portfolio under the My Portfolio tab. The Profit and Loss Portfolio is where we track our open positions. As we maybe make an adjustment, we sell a call using income method number 1 and then buy to close it. Well, you won't see that closed transaction in the Profit and Loss Portfolio. You'll still see your married put, but the closed transaction you'll be able to view in the historical reports or in the portfolio analysis tab here. Okay, so when you close a position or roll a position, you'll no longer see it in the profit and loss portfolio. Now the first thing I wanted to point out here is that notice on my portfolio I have this box checked for view position analysis. What that did is it added these sort of 8 columns over to the right hand side that are truncated right now, and I'll show those in a minute. Well, see, here's our new UGI position. Okay, we have our description. Here's my stock leg, 100 shares the quantity, my transaction date, the age. How long have I been in the stock? Well, we just open it so it's 0 days. And then the days in parentheses for the put option is how long we have to expiration. Our total net cost here, we bought 100 shares at $29.22, so that's $2,922. Bought one put at $265, so it's $265. The effective cost per share on the stock is $29.22. As I make adjustments, roll the positions, add different income methods, this effective cost per share is going to change. All right, that's going to adjust. Now the current price and change today, now this is interesting. That's going to hurt. It's something I actually would have checked earlier, and I skipped over that. But I usually limit the bid-ask spread on my puts when I'm looking for a new position. That's one of the filters in the search tool. I limit it to be less than about 50 cents, less than 60 cents. You see here we opened it at $265, but the natural bid is actually at $185. And the portfolio assumes that, well, it knows that you bought to open this put, so if you were going to liquidate it, you would most likely get the bid price. You'd sell to close at $185. So that's a wide bid-ask spread of 80 cents, excuse me, a little bit outside of the range that I might typically use. And you see we're down 30% on the put. Well, that's just due to the bid-ask spread. Now, when I check that box for view position analysis, it's great to see the individual legs, but I have no change on the stock and I'm down 30.2% on the put based on the natural bid price if I liquidated right now. But it's better to see that all together. So when I check that box for view position analysis, it puts everything together for me. So on this married put that we just opened, I currently have a position cost of $3,187, stock plus put. If we liquidated right now, if we sold to close the stock and sold to close the put, again, I skipped over that. I would have included that in my normal search. I apologize for that. But right now we have a loss of $80 or 2.5%. Now the future expiration value, this is not based on a probability calculation, for example, of where the stock might be trading at November expiration. It's just saying if the stock stays at the same price it is now, November expiration, well, if the stock stayed at $29.22, our expiration value would be $3,000. We'd exercise our 30-strike put and be out at $3,000, so that would be our full loss of 5.9%. Okay? All right, so that's just what I just wanted to show that because that's what you get when you check that view position analysis field there as well. Okay. All right. So Lloyd's question, I want to address that now. You see we have 2 other positions here. We have 2 Weyerhaeuser married puts. I probably pronounced that wrong, Weyerhaeuser. These were from other webinars. One that we opened on March 28th. We've been in it for 42 days. Another one we opened on March 7th with a different price and a different put. I want to take a look at this first one. We opened it 42 days ago. The stock was opened at $21.75. We haven't made any adjustments, but it's now trading at $19.82. So we've had a drop of about $1.93 on this Weyerhaeuser position. And we have the January 2013 25 put that we paid $4.55, and that's moved up about $125 for us. So really, right now, the stock's dropped 8.9%. But you can see as we scroll over, we're only at a loss of about 2.6% at this time, and the total loss was 4.9%. So we're about at 50% of what, our maximum risk on this married put after the first 42 days. Lloyd asked, Mike, do you try to close out a position in the same year, or do you continue to make adjustments regardless of time? Well, that's a loaded question, and not anything against Lloyd. There's really several parts to that, but the main parts I'm going to address, Lloyd, with this is why I saved your question, because I want to take a look at this Weyerhaeuser example. Now that the stock has moved, whether it's moved up or whether it's moved down, and we're going to take a look at the other Plains Exploration little collar here that was opened as a married put, and then we sold a short call against it. So you can see here that PXP collar that we have, well, it's still an RPM, it's just registered as a collar. We have a November 39 put, and we've sold it a May 39 call. because a collar, by definition, is any combination of long stock, long put, and short call. So in this case, it is an RPM, but I applied income method number 1. But we're going to take a look at that after. So our Weyerhaeuser position, it's down 8.9%. In regards to Lloyd's question, well, now that my stock has dropped, it obviously is not doing what I expected in the first 30 to 60 days. We're 42 days in, and it's down 8.9%. What I want to do is analyze, are there any adjustments that I could make on this position? And to do that, I'm going to use the More Information button here, and I'm going to go to Position Actions. And of course, just real quick here, if I wanted to roll the option leg or if I wanted to close the position, this is where we make our adjustments in the Position Actions menu from the More Information button. But I want to go to Position Analysis from the Profit and Loss Portfolio. The Position Analysis tool breaks down our position. It'll show us a little bit more detailed information of what we saw as far as the original expected gain or loss, the current liquidation value, and the future expiration value. So here's our original position. We haven't made any adjustments on it. We have our profit and loss chart. We have our initial maximum risk of 4.9%, days remaining to expiration, and so forth. Now, as I scroll down below the basic profit and loss chart, we see the 3 columns we've already viewed, but we have a little bit more detail. Okay, so my original position value, my original position cost. It doesn't show me my original expected return because that's infinite when I first open a married put position. Current liquidation value, we saw that, well, it would be 2.6% after 42 days. If I sold to close the stock and sold to close the put option, we'd have a loss of 2.6%. And again, my future expiration value, if I continue to hold it, make no adjustments, and the stock stays below our strike price by January expiration, January 2013 expiration is $25, well, we'd have the full loss of 4.9%. But down below that, we do see a couple rollout opportunities. Now, sometimes what I'm showing here is just an opportunity for income method number 9. There's a caveat with income method number 9 that's discussed right down here at the bottom. What we shows us we could do is we could sell to close the 250 put, January 25 put for 580, and maybe roll down to a January 23 put for 450, or the January 22 put. Down below here is a very important note, and those of you who own the blueprint, you know why this is here, but you can also see it in the maximum risk. Using this approach will lower our break-even point. We're readjusting the position, but it's also going to increase our risk. We have a 4.9% risk now. This increases our risk to 8% if we make this adjustment. And of course, those of you in the blueprint know the SIGA model for income method number 9. And why would I increase my risk? Well, there is a reason. And occasionally, in this situation, we have a stock that's down in price. You might see combinations for income method number 9 and number 1. Meaning with the stock trading at 1982 right now, sorry, if there's a larger premium available on the 22 put, for example, it may show me a combination of rolling down to the January 22 put and selling maybe a June 21 call or 22 call, for example, to help pay for some of that adjustment. All right. Now, we're not telling you what to do here. This is just giving you guidelines. We're doing the heavy lifting and doing the math for you. So we show you your new break even, your new potential at risk, and your new potential at risk per month. It's up to you to decide what your risk threshold is, and does this adjustment make sense for you? Of course, it's great to see it numerically, but anytime you see a rollout opportunity, probably also want to take a look at it graphically. So what I'll do here is I'll go to this, and I'll go to Simulate Trade. And Lloyd, I'm getting to the other part of your question in a moment here. When we go to Simulate Trade, what this does is it gives us a side-by-side comparison. Over on the left in red, in the red corner, is our original married put position, where we bought stock at $21.75, bought the January 25 put at $4.55. Here's where we stand right now. We do have a maximum risk of 4.9%. Maximum profit is still infinite. And right now our current return is a loss of 2.6%. Now if we make this adjustment here, the income method that we linked from, selling to close the January 25 put and buying to open the January 23 put, we see that we would have a new effective stock cost of $20.50, but now this would be a total cost of $2,500. So just the stock price has changed to $20.50. The effective stock price is $20.50, but we still have an option at $4.50. So our total invest is $2,500, but we have a 23 put now, so our risk is 8%, and we still have the infinite maximum profit. Our break even, though, remember our original break even at 26.30, that's at expiration, of course, but if we make this adjustment, we've adjusted the position, we've generated a credit by rolling down this put, we've lowered our break even to 25, but at the same time we also lowered our guaranteed exit, so that's what increased the risk. All right, so going back to Lloyd's question, when the stock has declined or you have a loss in the stock, oops, and you know, do you keep trading it or do you close it during the year? Well, this is along the lines of the blueprint, okay? And the blueprint describes when you would exit the position, you know, exiting an RPM. There's a whole chapter on exiting the RPM. When I'm analyzing this income method, I'm not just looking for what my new maximum risk is. I'm not looking for what premium I could generate on a stock that's moved up in price. What I'm looking for is I'm applying my SIGA model. What are my conditions? Well, I opened a married put that I expected the stock to move up 5 to 8% in the first 30 to 60 days. I'm 42 days in and my stock has dropped 8.9%. What are my expectations? I reevaluate now. Now that the stock has dropped, what are my expectations going forward? Am I expecting the stock to recover and move back up in price? Well, if that's the case, this adjustment might be opportune for me. This adjustment does increase my risk, but it lowers my break even. It also lowers my strike. So if the stock starts to come back and moves up to 23, I could do one of the bullish income methods now that I have the 23 put instead of the 25. However, if my expectation is, well, this stock is doing the opposite of what I wanted it to, there's a weakness in the stock I didn't see, this is not related to the market pullback, this stock actually doesn't feel to me it's going to grow, maybe I just want to liquidate right now, Lloyd, take that small loss of the 2.6% instead of holding it to risk the 4.9%, take that small loss and then move into another position that I may feel bullet on. Okay? All right, so Howard, so Lloyd, that's my answer. That's really described in the exiting an RPM chapter in the blueprint, but it's really based on my conditions and expectations. Howard asked, why isn't the position analysis available in all situations? Sometimes it might not make sense, Howard, to make an adjustment. A lot of times, for the past 4 years since we partnered up with Kurt, and Howard, I'm not singling you out, this has nothing to do with you, but I get this question a lot. You know, I opened a married put 5 days ago, the stock's moved up 20 cents, or has moved up 2%, why do I not see an income method? Well, based on the rules in the blueprint, it's not a good time to do that. You want the stock to move up a little bit more. You know, you want a stock to be traded. The blueprint discusses that when looking to do a bullish income method, you really want the stock to have moved up 5 to 8% or be trading at the put strike price. When the stock moves down, you might see some adjustments, but if the stock, you've only been in the stock 10 days and the stock's moved down 1% or so, you don't want to do an income method number 9 then. You want to wait. Give the stock time to move in your desired direction. You know, Howard, later on, if you send me an email, of course, we can talk about a specific situation that you're looking for an income method. But the rollout opportunities that are shown are based on the rules in the blueprint. If you don't see a rollout opportunity, it's not matching the rules. Now, when you stop and you said, okay, well, here's a good example, Howard. Here's a good example, okay? So we already talked about maybe Lloyd's question about liquidating the position versus doing an adjustment. Anytime I'm planning to do any income method, I'm viewing that simulate trade field and I'm applying my SIGA model. What are the current conditions? What are my expectations going forward? And what are my goals? Now, there's a quick comment that came in here by Lloyd, says, got it. So one has to decide whether he or she thinks the stock's going to go. Yeah, that's the part of the SIGA model, Lloyd, but we're not always going to be right. I can enter an income method number 6 trade on an RPM that's moved up 5% after I opened it and think the stock's going to continue to move up in price or stagnate. Well, it might drop. And that's okay, because what I'm also doing here, let's take the Wyeth example again. Let's go to simulate trade. What I'm also saying here is that, okay, well, if I make this adjustment and I'm expecting the stock to come back up, so I'm increasing my risk to 8%, am I still comfortable with that? Well, maybe, if that matches my risk threshold. However, if the only rollout opportunity that was shown were these two at the bottom here, okay, that had this 12.4% risk or 15.4% risk. If those were the only two that showed up, I'm not considering doing those personally, myself personally. Even if the stock has declined and I feel it may come back over time, I don't want to risk taking a 15% loss on my position. Ernie does it and he does it well. Ernie will take higher risks and use income method number 9, and I got to admit he uses it better than I do. But to me, I don't want to roll down this position, have the stock continue to fall over the next 30 to 60 days after this and get closer to a 10, 12, or maybe even that 15% at risk, because that's double my personal threshold. Okay, so at that point, I may decide to liquidate now with just that 2.6% loss rather than using an income method that matches the rules, but it's outside of my personal bounds. You still want to identify what are your personal bounds for stock prices we talked about earlier with Ray, or even the maximum risk. All right, now, Howard's question. Let me go to that. Remember, Howard, when I linked over to here, I said that sometimes you'll see a combination of income method number 9, and hey, if there's enough premium on, let's say, the 22 strike put, I may see a combination for income method number 1. Excuse me, ladies and gentlemen. I had to put you on mute there. Had a quick sneeze come on. Well, okay, I don't see these combinations for income method number 9 and 1. It's one of the bearish income methods you might see. But okay, let's go ahead now and close out our position analysis view. Let's go back to our profit and loss portfolio. Take a look at our Weyerhaeuser position. Well, I was contemplating maybe rolling down. The stock's at 1982. A little bit too low probably for this, but I'm contemplating maybe rolling down to the January 22 put as we discussed, and maybe selling a June 22 call, maybe use some premium. Why didn't that show up? Or maybe the stock has only moved up 2%, Howard, and you didn't see an income method number 1 opportunity that you wanted to use. Well, you can simulate that very easily. Let's just click on the More Information button again. But now, instead of going to Position Analysis, we're going to go to Profit and Loss Chart. Well, we've seen this 3 times today, so this is nothing new. It shows us where our expected gain or loss is, what our gain and loss is at the halfway point, and we can run our what-if scenarios down below. But if I scroll up to the top, I now have 4 other fields. Here's my position, my long stock and my long put option, and I have 4 other fields I can use to simulate an adjustment. Okay, so let's simulate selling to close the 25 put, buying to open the January 22 put, and then selling a June 22 call. Okay? And so what I'm going to do is I'm going to click View Options up at the top, and I got to go to my available month, my January 2013. Let me click on that, and we see that the 25 put has been added. Well, that is part of the initial position, but I can click that again, and then that adds it back in. Okay, so you see here that just added into the 3rd leg, and we're going to simulate selling that 25 strike put. Okay, we're going to sell to close it. Now, I'm not going to worry about the wide bid-ask spread. I'm just going to grab the natural bid price at 570 when I hit submit. Okay, then we're talking about rolling down. So we're selling to close January 25 put, buying to open a January 22. Okay, so I clicked on that. It shows me it's been added. There's the 22 put. I'll put in 1 contract. Now, at the same time, well, let's just see how that would look first. We saw it on the other screen, but let's just do that part. Let's click Submit using the natural bid and ask prices. Okay, so we've increased our risk now to 9.5%. We've lowered our break-even from where it was. I believe it was at $26.30 down to $24.30. Okay? Oh, sorry, question came in. All right, and so now that we've done that, let's simulate doing the combination of 9, which we just did, which increased our risk to 9.5%. Now try to sell the 22 call. Well, of course, it's Weyerhaeuser. This was a dividend-paying position, so we don't have a lot of premium there. But let's just put it in, and we'll put it in at 20 cents. With 1 contract, it would cover my commissions, but not much. We'll cheat. We'll put in 25 cents there. Okay, so I'll go ahead and hit Submit. Now we're at an 8.6% loss, but what's the problem with the 9 and 1 combination? Well, now we have a very tight range of profitability to June expiration. We really can't afford to have the stock go too much above $22. And if the stock does move above 22 now, it's going to cost me more than 25 cents to buy to close that call, and that's actually going to add back into my risk and moving in the wrong direction. Okay? All right. So using the profit and loss chart, you can simulate these adjustments, Howard. If you don't see a rollout opportunity that you are considering or thought you should be there when you go to position analysis, everything that's programmed into that position analysis view for the rollout opportunities is based loosely on the rules in the blueprint. For income method number 1, for example, that we give away for free, just selling the call against the stock as it's moved up in price. you want to make sure that you're still above the put strike price. You probably don't want to be more than 60 days out in time. You want to collect a premium that's at least maybe close to a fourth or a third of the initial at-risk price, and at least 30 cents bare minimum. So it has to match those basic rules. And if it doesn't, then it won't appear. Also, as I mentioned in the rules in the blueprint, some of the basic ones, the basic income methods, are best done when the stock's trading at the put strike price. But as a general rule, the bullish income methods will show up if the stock has moved up 5%. That's kind of a trigger. You want it to move up at least 5% or so before you see that. All right, Lloyd said, you find it hard to liquidate a loss, you hold stock a long time. Personal problem. No, I'm not going to call that a personal problem at all. Ernie stays in married put positions much longer than I do, and he will fight tooth and nail to get that to profitability. Even if he's used income method number 9 2 or 3 times and maybe increased his risk to 15%, he's staying in that position and rolling calls, and he's been very successful with doing that. I tend to veer halfway between kind of Kurt and Ernie. Kurt sometimes will get out of a position really quickly within the first 20 or 30 days if he just feels, well, I'm going to get out at a 1.8 or 2% loss, and he trades more actively than I do. I will give the position a good 90 days. I might use one income method number 9 if it moved against me in those first 90 days, Lloyd, as well. But in general, I don't want to have the prospect of staying in a position for 6 to 8 months or 9 months to make only 1% if I don't think the stock's going to recover. That being said, my very first RPM on Office Max, when I got into the stock dropped 75% after I opened it. Not the day of, but I was in the position for about 6 months, 7 months. And the stock dropped over that time from $20 down to $5 per share. And I used income method number 9 several times and then was able to readjust it later before it collapsed all the way down to $5. And I tell you what, at that point I was very happy to have a 1%, 1.6% gain on the position because I was long stock the entire time. And only lost that. All right, is this Michael, H. Michael. If you buy a near the money January 2013 put, the delta will be near 5. So you don't get dollar for dollar protection, and you can lose money on both the option and the stock. Wouldn't it be better to buy the put closer in and roll it out about a month before expiration? Okay, so, well, you can simulate that. Okay, so remember, let's just clear this out. I think I understand what you're asking, but I may have confused myself. It's not the way you phrase it. I think I confused myself as I read it and was trying to understand it. I think what you were telling me is that rolling to the 22 put, which is, it's still in the money now, but you're saying it's closer to at the money here, the 22 put. By that increased our risk, remember, to just 9.5%. I believe what you're asking, you get the dollar for dollar protection, you can lose money on the option premium stock. Wouldn't it be better to buy closer in and roll it about a month before expiration? Well, if you think that's the case, simulate it. That's what these tools are for. Okay, so instead of rolling to the January 22 put, what happens if we sell the January 25 put and now open a June 25 put? Let's keep it at the same strike for the time being. Okay. Okay, well, our risk is up to 5.3% now, and we've got 30 days to expiration. Here's, I think I set this up right. Let me know, Michael, if that's the kind of setup you were looking for, if that's what you thought would happen. If this is the setup, you're talking about being close to the position here. Okay. All right, I have a couple other questions. The reason why I'm bringing this up is my maximum loss if I held the position right now to January 2013 expiration was 4.9%. By rolling near term and keeping the same strike, I actually increased that maximum risk to 5.3%, and I have a much higher probability of realizing that full loss of 5.3% in the next 30 days. So in this scenario, I wouldn't do it. You know what I would do at this point? If I wasn't expecting a stock to come back up, if I wanted to shorten my time frame to try to generate a little bit of credit here and not increase my risk too much, well, I did increase my risk by selling and close my January 25 put and rolling into the June 25 put at this point. It did increase my risk. It's probably due to those wide bid-ask spreads. I know that. We're just going with natural bid and ask to keep things simple today. But I wouldn't do this. If this was the case, if I was analyzing this and I was contemplating this, rolling this in, and it increased my risk from my maximum risk, and in 30 days I realized I have a higher probability of realizing this 5.3% risk if I'm not expecting the stock to move up too much in the next 30 days, at that point, Michael, I'm probably just liquidating the position, taking my 2.6% loss and moving on. That's me personally. But you have the tools here to analyze that. If you wanted to try that adjustment, then you could do that. All right, Steve, if a move down, we are in the question period, by the way, because we're about 20 minutes over, so if you have questions about the tools, go ahead and send them in. I'm going to keep on this screen for now. But Steve, if a move down is due to market conditions, like yesterday, is it a better choice to wait and see where the market goes? Generally, it's not likely that perspective on the stock has changed based on general market move. What are your thoughts on this? My personal thoughts, Steve, are exactly what you said. If I'm in a stock that I'm still long-term bullish, I had opened something 10 days ago, and my thought process, as I mentioned, is the stock's going to move up 5 to 8% in the next 30 to 60 days. 10 days after I open the position, the market has a pullback, and my stock's down 5 or 6%. I don't think I'm looking to do an adjustment at that time at all. I'm still, with the market pullback, if I still think the stock is strong, I'm still going to expect it to move back up in price probably in the next 40 days from now, 30 days from now. So I'm going to leave it as is. Personal preference on my point. And that what you said is that's exactly right. If it's related to the market itself and I'm still more bullish, then I'm going to do that. Oh, okay. Mike, Howard, you were talking about another thing. Okay. Howard originally, but it was a good example I walked through, Howard. I hope you got some use out of that. You were talking about those times when open the more info and all I see is profit analysis. There is no position analysis on the page. Yeah, for some of the positions that come across as a custom spread, where the system can't read it as a true just option strategy that we have programmed an analysis for, you won't see that. This may happen with a income method number 6. If you have an income method number 6 or 5, right now we don't have a position analysis calculated, and I apologize for that. We're going to get to it in a little bit. We're doing that right now for showing other rollout opportunities. I'm working on income method number 7 right now with the programmers as well, and then adjustments after that. But it's going to take some time. So I'm sorry about that, Howard, but when you make an adjustment and it shows up as a custom spread in the profit and loss portfolio, you will not see a positional analysis. Joseph, do these methods apply well to weekly options? Yes and no. What I mean by that is that Kurt has entered RPMs for his Fusion portfolio, his Fusion subscribers, using stocks that offer weekly options. I'm not going to buy a married put with a weekly option. Oh, no. I'm not going to buy a stock and buy a put in a protective strategy with a weekly option because that's just too quick of a time decay. It doesn't make any sense. It goes against 2 of the 3 rules for the 3 core principles of radioactive trading. Can I use adjustments, income method number 1, number 6, number 5, if a stock offers weekly options? Yes, but you shouldn't do it, and you shouldn't look to do it based on the fact that it offers weekly options. What I mean by that is that if I just went into a stock, a married put position, just because it offered weekly options and I want to apply the income methods, I don't want to trade an income method week by week by week. It still has to match the rules for the income methods, the SIGA model. I can't plan on trading an option week by week by week or doing an adjustment week by week by week because the stock might not have moved to where I think it's a good idea or matching the rules to apply an income method. But absolutely, you can trade stocks, you can trade married puts with the weekly options, but you can't force yourself into a position. If you force yourself into an income method too soon, you're going to end up getting into a worse position where you can have higher losses on the upside in the direction you think the stock's going to go. Using income method number 1 too soon can be disastrous, and I've talked to customers who've just attended a webinar, went out, opened a married put that they found using the search tools, sold the call right away on it. The stock moved up as they expected, and they actually realized a 10% loss on the upside because of the limitations of the short call or one of the other income methods. Steve, now what if the market pullback happens later in the trade? Well, I have to analyze where I am. Hopefully, say closer to my 90-day period, hopefully at that point, maybe I've already made 1 or 2 adjustments on the RPM, so I've lowered my risk from maybe 5% to potentially 1%, or I've bulletproofed the position and then it pulls back. Well, I can look at it then. Again, it's got to come down to what I think is going to happen next and what my personal preferences are. So let's say I was in a position where I lowered my risk down to 1% and the stock pulled back. I'm in my 90-day time period. Depending on what I think is going to happen in the next 20 to 30 days for that, I might stay in the position as Lloyd talked about, because we don't want to suffer a loss and we don't want to get out in that fashion. But it's kind of personal preference. Kurt or Ernie would probably tell you that, yeah, I'd stay in the position. You know, you've lowered your risk a little bit. You've already done 1 income method. If the market's pulled back, well, you can probably do a 9 then. Maybe add a little bit more risk, but increase your time in the position if you think long-term it's going to come back bullish as well. There's a lot of things that you can do there, and that's all discussed in the blueprint. Okay. All right, so let's wrap up. If you have any other last questions, send them in. I'm going about a half hour over. I apologize for that. So if you've got any last-minute questions, go ahead and send those in. This is pretty self-explanatory in my eyes, and this is what I tried to present today, why power options for radioactive traders. Well, the only suite of tools dedicated for Kurt's radioactive trading techniques and what's described in the blueprint. Patented search to find new positions that you can tweak and you can adjust the criteria based on the stocks you like to see and your risk threshold. Customize the searches and the screen views as well. Those one-click links to further detailed research and analysis, and of course the Power Options management tools to help you track the positions, evaluate rollout opportunities, simulate those rollout opportunities, and then we can also apply the adjustments, the income methods with one click. I didn't show that, but when you're in that simulate trade feature, when you're looking at the positions side by side, there's a button down at the bottom where you can click on it just to submit the trade into your portfolio so you don't have to do that manually. Oops, sorry about that. Since we focus on the Power Options tools, the 20-minute delayed subscription gives you access to all the tools in the tool menu with 20-minute delayed quotes is $60 per month. We also offer a real-time service. It's not streaming real-time, but every time you refresh the page or get the numbers, refresh the page or resubmit a search, you get the numbers and calculations at that instant, and that's $80 per month with about a discounted annual rate of $880. We do offer historical suite of tools, historical data. You can subscribe to a 3-month access to the historical tools on top of the 20-minute delayed service for $99.95 for 3 months. But if you already have the real-time, it's cheaper just to upgrade to the real-time plus historical. That goes to $100 per month, or $1,100 for the year, so a discounted annual subscription there. Well, most of you are familiar with the educational products. The blueprint is the blueprint in the home study course. The blueprint is the full work, 250 pages plus text, which describe the initial married put setup, why we're entering these positions the way we do, and of course the full information of the 10 different income methods in the SIGA model for each 10 different income methods. Now the blueprint is $339. You can see that in the products page, RadioActiveTrading.com. It does come with a money-back guarantee. If you're not satisfied with the blueprint in the first 30 days, just send it back to us and we'll refund your money. And of course, it does come with several bonuses. Some of those include a free month to Power Options. So you get a full 30 days to Power Options if you purchase the blueprint. Kurt's going to send you a free Foundations of Radioactive Trading CD, one of his 6 Mastery Series CDs as well. And you'll also get a discounted first month to Fusion, his service where you can follow Kurt and Ernie's trades. And Kurt also has some prepared lessons on the Fusion subscription as well to help you absorb the radioactive trading material. And the Radioactive Home Study Kit. Now this is the blueprint and all 6 of the Mastery Series CDs at about a 35% discount. Each Mastery Series CD is about 2 hours long, and it discusses 2 of the different income methods in a different format of video CD, media presentation format. So if you learn better that way, you might want to check out the Home Study Kit. Now that's $5.99, but that is still a 35% discount of what it would be if you bought the blueprint and the Mastery Series CDs individually. It also comes with a money-back guarantee. The bonuses I mentioned, plus if you pick up the Home Study Kit, you can get a 1-hour free radioactive consultation with Kurt, Ernie, or potentially myself with that purchase also. And you can check those out at RadioActiveTrading.com and just go into the products page. I'll just type that in. I should have put that on the link here, but that's okay. So for the educational products, just go to RadioActiveTrading.com. You can take a look at further information about the blueprint or the Home Study Kit. Well, ladies and gentlemen, sorry I kept you a little bit over. I thank you for joining me today. Thank you for the participation and the great questions. Howard, Ray, Jim, of course, and Steve. All you guys, thanks for chiming in and helping me with the presentation, helping me move that along. If you have any questions later on, you think of anything later on, you can send us an email to support@powerop.com or support@radioactivetrading.com as well. And, of course, you can also call us during market hours. Toll-free inside the continental U.S. is 877-992-7971. Then outside the continental U.S. is you can reach us at 302-992-7971 as well. So just give us any call. Okay, Robert, you sent in a question, and I'll have to email you later, Robert, regarding that. He just purchased the blueprint but hasn't taken advantage of that free trial time he received yet from Power Options. So I will send you an email, Robert, about how you can start that free trial time that you got with your blueprint purchase, okay? And I'll send you an email there. All right. Ladies and gentlemen, thank you very much. Remember, tomorrow, Thursday, 12 noon Eastern Time, Kurt's going to host another radioactive trading presentation where I think he's going to get into those nested spread trades, income method number 5 and 6, maybe some others. So you want to make sure you can join us if you're available. And we will talk to you guys soon. Happy trading, and take care. See you guys tomorrow.